Can everyone see that? Can you guys see my screen? Okay.
Yes, we can.
All right. I am just going to go on through. This is the financial cures prescription. As I said, I'm the, financial healer. So my imagery is based around the financial medical approach. Robert Kiyosaki says it's not about how much money you make. Sorry about that. Let me get it together here because I push a button. I'm trying to get my screen to show different. Okay. It's not about how much money you make, but how much money you keep, how hard your money works for you, and how many generations you keep it for. Because we are talking about making money, not just from our books, but from our businesses as well. Now, the benefits of writing a book, there are a number of them. It tells you, why you're an expert, because you can say, I wrote the book about it. It's valuable intellectual property. You pour into others with the information you provide. It's a resource tool, and it's worth more than money. It's kind of leaving a legacy, and it maximizes your exposure. Now, there's a lot of focus on physical health, mental health, social, and even social health, especially since the pandemic, but no emphasis on financial health. And people confuse and conflate financial literacy with financial health. And the difference is, or financial health with financial literacy. And the difference is you can be financially literate and still have poor and even fatal financial health. Now, I love this by Wayne Dyer. We talk about mindset. So if you change the way you look at things, the things you look at change. So you don't want to say, oh, I can't afford this. You want to ask yourself, how can I afford it? Or you don't want to say, oh, I can't be an author. You want to say, how can I be an author? Or anything that you want to do, you don't want to use the word can't. You want to ask, how can I? So regardless of what you're trying to achieve, you want to say, how can I? Because when you change the way you look at things, the things you look at change. Now, there's some basic principles that you want to understand. You never want to estimate the power of the basics. A lot of times we want to go way over here and with the big things, but we don't understand the basics. So it's important to understand the basics, but never underestimate it. Discipline. There was someone else that talked about discipline, and that requires you to choose what you want more over what you want now, especially when we're talking finance. You have people, they see, oh, this big shiny object, a purse or some shoes or a car, and they want it now, but it really could impact what their long-term goals are. So you want to have that discipline so you can choose what you want more over what you want now. And you want to plan where your money goes instead of wondering where it went. I don't use the word budget anymore because, people get turned off, they shut down when you say budget. I say, okay, let's plan where your money goes, because there are a lot of people, and I've been one of them, you make a lot of money or you do something and then you're like, well, Dad, where did my money go? So, you want to plan where it goes instead of wondering where it went. You want to spend less and keep more of what you make. And then more money can't fix bad spending habits. There are a lot of folks that make a lot of money, but they spend more than what they make. So, getting more money is not necessarily going to, resolve that. And then money saved is money earned. You want to differentiate your needs from your wants. Needs are things that you can't live without, like food and clothing and, a roof over your head, and, gas in your car to get you to wherever you need to go. But wants are things that you can do without. You may think you need them, but, you really don't necessarily, you just want them. I did a conference at my church, and I asked people to throw out, what are some of their needs? And, people were saying like rent and food, utilities. And I asked, and one lady said paper towels. And I'm like, okay, paper towels. Now I'm a paper towel girl myself. I love some paper towels, but that's not a need. You don't have to have paper towels. You can get by with wiping your hands on a regular towel. You don't have to have paper towels. So you have to really, and when, be real about what your wants are. You may want to get certain, vegetables, but you don't necessarily need organic, even though it's healthier for you. But if you're is tight, just get the vegetables and don't worry about it being organic to start with. And you have to understand the difference between expenses and debt. Expenses are things that are going to reoccur, like utilities. You pay it off this month, it comes back around next month. So no matter how often you pay it off, it's still going to come back around. But debt is something that it's a fixed amount of time, like a car note or a mortgage. You got a fixed term of how often and how long you're going to pay that. And once you make that last payment, then that's it. The debt is satisfied. So you need to distinguish that, especially when you're planning where your money goes, and especially if you're trying to get out of debt. And you want to control your spending. I have my clients do a spending challenge before they work with me. What they do is they track everything they spend, whether it's a stick of gum or whatever. They take, a journal. I give them a journal and it has a little pocket in it. And they can either, take the receipt, put it in the pocket, or they can log it in at the time, whether it's, how much it was, what it was for, whether it was a need or a want. Did they pay cash? Did they use the debit card or credit card? Because, if you use a credit card and you didn't pay it off in the month, it's going to cost you more than what, it originally cost. And then at the end of a day or a week, I have them do it for 30 days. And at the end of the period that they choose to tally things up, they determine how much they spent on needs and how much they spent on wants, whether they paid cash or a debit card, or if they get a credit card. And, it's an eye opener. I have one gentleman, he said, Wendy, I spent $600 eating out this month. I said, okay, he's a businessman. I said, so which took a lot of clients out or what? He said, no, it's just me and my wife and sometimes the grandkids. And it wasn't that he couldn't afford it, but it was an aha moment for him to like, Dad, that's $600. I could have paid a utility bill or put that in, aside in my emergency fund. And I had a colleague of mine, I went on her podcast, and while she was listening to me talk about the spending challenge, about a couple months later, she called me up. She said, Wendy, I did that spending challenge you were talking about. And me and my husband spent $3,000 last month eating out. And I'm like, $3,000? You could have paid a house note, a car note, utilities, all kind of stuff, car insurance. You could do all kind of stuff with $3,000. And she really, like I said, was an aha moment for her, for them really, because that's a lot of money eating out. And they weren't necessarily, spending that on clients either. They had grandkids and it's just her and him, and they were eating at these fancy restaurants. And it's like, okay, what do you have to show? Extra 50 pounds or something. But, it's those kind of things. It's an eye opener. It makes you more conscious of where your money is going. Now, I want to talk about the rule of 72. I'm not sure if you're familiar with this, but if you understand this, this is how you make your money compound. Now, you've got 4%, 6%, 8%, and 10%. These are your rate of returns. And then you take your money that you have. We started with this example of a 34-year-old with $10,000. Now, if they get 4% return, it's going to take 18 years for that 10,000 to double. So every 18 years, the money will double. Now at 6%, it's going to take 12 years. So as you can see, at 4%, by the time they're 70, they have $40,000 based on, the compound interest rules. But at 6%, they get 80,000. At 8%, it doubles every 9 years. So at 70, at 8%, it's 160,000. And at 10%, it's every 7 years. So at age 70, they have 320. But you notice, even though that 2% difference in rate of return results in doubling what it would have been at the lower rate. So I don't know about you, but I want to be at the 10%, getting the 320,000. So you want to know, how can you earn higher interest rate without putting your money at loss? And we'll get to that. Now, here's another way of how compound interest works with debt. That was with investments. This is with debt. Now, I know some people would say, oh, I don't want to have any credit cards. I don't want to have any debt. But having a credit card doesn't necessarily mean you have debt. Now, this will show you how compound interest works with debt. Now, you can charge $1,500 on your credit card. If you make that full payment that month, when the bill comes, you pay 0 interest. You've used that $1,500. So, it's like a wash. But if you make a partial payment, say, I don't want to put out $1,500 to pay that off, you only pay $135. It'll take you a year to pay that debt off, which will cost you $125 in interest, and you'll end up paying $1,625 back. Now, if you just make the minimum payment, which a lot of people do, and I don't recommend it, but sometimes things get tight where you got to just do the minimum. But if you just do the minimum the full time, it's going to take you 11 years to pay off that same $1,500. You're going to pay $1,413 in interest, and you're going to end up paying back $2,913. So at this point, you don't even know what that $1,500 went for. So if you can see the difference of, compound interest working for you with investments and with debt. So you want to stay away from making those minimum payments. But if you have to, do it for as long as you have to, and then go back to paying it out completely. Now, you want to avoid the risk of financial disaster. And I guess I'll tell my story here, which I probably should have told it earlier. But I started my entrepreneurial journey almost 4 decades ago. And I can't believe I'm saying 4 decades. I didn't have any business experience and very limited financial resources. And back then there was no internet, no social media, and the only thing you can do with a cell phone was make an expensive phone call. So my clients were corporate America and government agencies. And like I said, there was no internet, so it wasn't any online shopping or any of that. You had to have a brick and mortar, employees, carry inventory, and all the overhead that goes with that. And I was able to do that initially. And as I, got business, I was able to, have the numbers on the books, but I didn't have the money in the bank. So you have to, know your costs for one. You got to know what it costs you, whether you sell anything or not. What does it cost you to keep those doors open? And you have to make sure that your profit margins align with that. But anyway, I made it through. And in 2014, when the government mandated that everybody have health insurance, I expanded my business to include insurance and financial services. So I bought all the products I was selling to my clients, the health insurance, the life insurance, all the supplemental coverages, not from a personal, financial planning perspective, but more from a business marketing perspective. And thank God I practiced what I preach, because in 2017, I was diagnosed with a very aggressive form of breast cancer. And that meant, I chose a very aggressive form to conquer the disease, which meant chemotherapy every 3 weeks for a year, 5 surgeries, all the labs, the CAT scans, PET scans, MRIs, and everything it took to, conquer the disease. And my medical bills totaled almost $1.5 million. But because I practiced what I preached, my insurance paid all that. I think I had to come out of pocket with like $600, which was my maximum out of pocket. And then all the supplemental coverages that I bought from a marketing perspective, not because I thought I'd ever use any of it, but it paid me multiple 6-figure financial shots in the arm that were tax-free, that allowed me to, just recover and not worry about money. But can you imagine having that kind of medical bill total while you're, dealing with breast cancer and having a business expenses and personal expenses. It's just, it could have really ruined me financially, but thank God it didn't. To avoid the risk of financial disaster, I make sure that my clients have health insurance. There's a cost to having health insurance and a cost to use it, and you have to know the difference. There are a lot of people that have health insurance, and I think 60% of the bankruptcies are due to health related, expenses or medical bills. And, I think about 90% of the people had health insurance. So you have to know, your deductible, you have to know your co-pays, your maximum out of pocket. Those are the costs to use it. Your premium is the cost to have it. And just because you have an employer plan doesn't mean that it's going to be affordable for you in case something happens. You want life insurance with living benefits. A lot of people don't know about living benefits, and living benefits can save you big time because what it does is allows you to pull 90%, up to 90% of your death benefit in case of heart attack, stroke, cancer, and some other diseases. So let's say you have a $500,000 term life with living benefits and you get diagnosed with, stage 4 cancer. You can withdraw $450,000 from that policy while you're still living and do whatever you want to do with it. There's no limit or restrictions on what you can do with the money. And you'll still leave your family with $50,000 if you choose to, take that amount. And that'll bury you. It'll leave them a little something. So, you understand, life insurance, and not just term, but whole life as well. But make sure it has living benefits. Because, life insurance can take care of your family when you die, but living benefits will help take care of you while you're living. Now, I talked about, the interest and indexing, what I recommend to my clients, index universal life, because what that is, it's indexed to the market, but not in the market. And here's an example of that. This is, an investment of $1 in 1998. As you can see, the red is indexed to the market and the blue is in the market. So in 1998, $1 was invested. And then in 2000, that's when the dot-com industry was booming. So that same dollar turned into $1.47 in the market, but indexed to the market, it was $1.30. And I guess let me explain indexing. That means you have a floor and a ceiling. And it depends on what product you choose. You can have a 10% ceiling and a floor that has 0.25% or even zero, where zero is your hero. So say the market, returns at 12%, and you have a 10% ceiling, so you're only going to get, say, $1.30. But as you can see, as the dot-com industry crashed, that they didn't have a floor in the market, so they lost money, and that $1.47 turned into 94 cents. But because the index product had a floor and it had a 0.25% floor, that $1.30 ended up being $1.31. So when the market started picking up, then index to the market started from the 131 and went on up, where in the market started from the basement and they went up. And yeah, they ended up getting a little more. And this is when the housing market was booming. But as you can see, when the housing market started tanking, they ended up with less than what they had initially and when the dot-com industry tanked. But here, indexed to the market, they ended up, that floor caught them and they ended up making money. So when the market picked up again, they went up. And when it, kind of stabilized up and up, and here you started from the gutter. So say that was $100,000 in the market, you would end up with 235,000, indexed to the market 425. So you want to make sure that, those folks that want to buy, use the market as their measure, get it indexed to the market and not in the market. Now, here's a financial blueprint. First, you want to set your financial goals. Then you want to develop a plan. You want to implement or take action with that plan. You want to review and update the plan regularly because things change, as you can see in the previous slide. And then that builds financial security and a financial legacy, and you end up with a big fat pile of money. Now, there are 4 sites to optimize your financial health. The first one is hindsight, and hindsight's always 20/20. You can always look back and say, okay, yeah, you see it clearly because it's already happened. Then you got insight, which is basically seeing what happened and saying, okay, what did I learn from that? What kind of insight did I get from that? Then you got foresight. So you say, how can I take that knowledge and that experience and move forward with it? And then you got your oversight, which are your checks and balances to make sure that you catch those kind of things well in advance before they get to be a disaster. Or really so you can make the appropriate changes when necessary. Now, Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. And writing a book can be a source of passive income. Once you put it out there, you get the exposure, people start talking about it, then you start getting residual checks without doing anything after a point. You do have to do something initially, but it's, like finding a way to make money while you sleep. And here's my quote: when you think right, speak right, and do right, things will flow right to optimize your financial health. And when I say things, I don't mean money. I don't mean just money. I mean opportunities, ideas, relationships, and all kind of things that you need to get to that next level. And I want to thank you for listening to me. I have a show, Financial Cures with Dr. Wendy Labat. It's available on Zandra TV, Roku, Amazon Fire, Apple TV, or you can go to FinCures, that's FINCURES.com, and you can see the first 2 seasons. The first season is about your personal finances, and the second season is about business finances. And here are my books. Diagnose Your Financial Health is book 1 of my Financial Cures book series, and Optimize Your Financial Health is book 2, and I'm working on book 3, which is Protect Your Financial Health. And these are all available on Amazon. So I got my QR code that has all my contact information. So feel free, and it even has a little brief bio. Feel free to scan that if you'd like to. And I'm open for questions. I'm going to stop my share. Okay. Anybody have any questions? I hope that was informative.
Very much so. I have a question for you.
Okay.
I really appreciated your explanation of indexed to the market versus being in the market and at risk. Talk to me about tax deferred versus tax free. I understand there are 2 different approaches to how people will save, for the future. What are your thoughts on those approaches?
Well, I'm a tax-free kind of girl because, for one, tax deferred just means that you'll pay taxes when you pull it out at a later date, really when the money is worth more than it was when you initially invested it. Now, one thing I like about the index products, you can get them to be tax-free. It depends on how you structure it, how you get out. Now, a lot of people put money in 401ks, which is good, especially if your employer is going to match it. But it's like paying tax, buying seeds and not paying taxes on it. But then when you get that harvest, you got to pay taxes. So I don't know about you, but I would have paid tax on the seed versus taxes on the harvest. So you got your qualified and non-qualified. So I would say go with the tax-free, even if you pay the taxes up front. That's paying taxes on the seed versus the harvest, because your harvest is going to usually be more than your seed. Does that answer your question?
It does, although I'm going to ask you to take it one step further.
Okay.
So my understanding is when you're really using, tax advantaged or tax free accounts to accumulate, you can access that money tax free. But when you pay the taxes up front, basically from that point on, taxes are not a consideration.
Mhm. That's correct. Now, like with an index universal life policy that I talked about with the term with the living benefits, when you pull that money out, you pull it out as a loan. So you're not paying taxes on it. And when, if something happens to you, that money's paid back out of the proceeds from the benefit. We still, like I said, leaves your family with, some money, but the tax-free is the way to go. Because, even if you pay taxes up front, it's still on an amount that's less than what it will be as it grows. So, the dollar isn't worth as much 10 years from now as it is now. So I'd rather pay the taxes up front. Or really not pay taxes at all, but pay taxes on the seed. Does that better clarification?
That was beautiful. Thank you.
Okay. Mhm.
Who else has questions for Dr. Wendy?
Okay, looks like everybody's over. Yeah, I could have gone into some other stuff, but I didn't realize, like I said, I figured I didn't know what my timing was going to be like, but, and then money, everybody's so funny about talking about money. And I tell my clients, look, what I'm teaching is from personal experience. I've been foreclosed, repo, bankrupt, all that. And people see me now and they're like, oh, you're doing so well. It's like, yeah, but I am, in senior citizen here. And, it's a matter of, learning from experience, learning the hard way. I've had some struggles and I still have struggles. It just depends. I'm just better at handling them now because I'm, wiser. But, things happen. We look at the economy. People don't realize there's 6 obstacles that, keep you from optimizing your financial health. One is and I guess it's okay for me to go back into a little presentation thing here.
Oh yeah.
One is mindset and knowledge deficiency. If you don't know about the basics, if you don't know how money works, if you don't know how compound interest works, then you're going to end up, making some mistakes that are going to cost you. Then you have to take control over your finance. That means that, you have to control your money and not let your money control you. You have to plan where your money goes instead of wondering where it went. You have to understand the difference between your debt and your expenses, and you have to take advantage. And I have a course on, well, it's not I guess a digital course on increasing your income without getting a second job, using those points and rewards to get. I'm in the process of remodeling my husband's man cave. He's got a full kitchen, full bathroom, a little area that he entertains, and we're redoing all that. I bought a dishwasher, refrigerator, stove, cabinets, bathroom vanity with my points. It's not costing me any money. I bought this $200 5-gallon $200 paint for $50, but I didn't use cash. I used my points. So those are the kind of things that you have to understand how to maximize the opportunities to get points. We just came from DC. We stayed in the Marriott, but we used points. We didn't pay for that. We were at the Mayflower, which wasn't cheap. If we would have had to pay, then we got our tickets using points on Southwest. So that trip was basically free. And then a friend of mine had access to get tickets to the African American Museum for 2 days for us for free. And those tickets were like $90 a person, per day. So it's those kind of things. That trip basically cost me nothing, because once we got there, we ended up getting $500 in vouchers to pay for our meals. So those kind of things help you, ease the pain of inflation. If we would have had to pay for those flights and the hotel would have been expensive. So you have to understand that there are ways to, take advantage of that. And then we talk about, Dave Ramsey talks about, no credit cash only. But if you have the discipline to use your credit cards, build up the points and pay it off without that compound interest accruing, then, that's how you ease the pain of inflation. So don't be afraid of credit and credit cards, but you have to be disciplined. You have to pay that stuff off. I'm not saying get in debt. I'm saying take it and use it as a tool, because that's how you benefit and increase your income without getting a second job. Then
There
you
was
want
a
to
question.
oh, go ahead. I'm sorry.
There's a question, and I hope, is it Marilla? Is that correct? Marilla had a question about what steps are different if a person wants to go the tax-free accumulation route. What are the different steps that you have to follow there?
Well, the different steps is finding out what product you're putting your money in, because, these financial things are products. It's just like anything else. You have to, compare. It's looking at, like your 401k. That's one where you get the tax-free seed, but when you pull that money out, depending on your age, not only will you pay taxes, but you'll pay a penalty, and you can't really get around. I'm a tax preparer as well. And if you're under 59 and a half, that 10%, you can't even write that off. As far as at the bottom line, they say, this is your tax liability. Next line, here's your 10% for pulling out of that 401k. So you have to really look at what's being offered. Annuities, again, paying tax on the harvest. You get a free, the tax, you get free tax-free seeds, but you're paying taxes on the harvest. So you want to look at, is the money tax-free when you pull it out, or tax deferred? If it's tax deferred, then you're going to pay money when you pull it out, pay taxes on that money when you pull it out. So just, ask those questions. Is it tax-free or tax deferred when you pull the money out? Because that's the key, is when you pull it out, is it tax-free or tax deferred?
It seems like there would be some risk there too. I haven't heard of any, major tax hikes, but I don't see taxes going down anytime soon with the way that spending, government spending is taking place.
And depending on your tax bracket, now, if you are one of them 1%ers, then hey, you fine. But most of us aren't. And then two, even if you are, I don't know, if I was a 1%er and I had all this money, I wouldn't mind paying taxes. But, at my stage, I do well, but I don't want to have to pay most of my money in taxes. Especially I'd rather pay, give it to somebody other than the government. But it's, you just have, and then you have to check the tax laws and tax codes, because a lot of people don't even think about that. They just, give their information to their tax preparer, see what they come up with. But you got to have a strategy going in each year. Depending on where you are now, you need to have a strategy for the next tax year, because that can hurt you. A lot of people say, oh, I don't worry about it, or I know I'm going to have to pay taxes. But if you have the right strategy, you don't have to pay so much, or you may not have to pay at all, depending on how your finances are structured. So make sure that whoever does your taxes, and I tell a lot of people, they want to go the cheap route, and especially if they got kids, they want to earn income credit if they're at that stage of income. And then some people say, well, I know I'm going to have to pay, but you don't always have to pay. Having a book, being an entrepreneur, gives you those tax breaks that you can write off, especially if you're an LLC. Now, if you're a corporation, depending, if you lose money, yeah, you can write that off. But when you start making money, you're kind of double taxed, because you pay it at the corporate level as well. That profit goes on your personal tax return. So like I say, you got to really have a strategy. And then you have to factor in global economics, because a lot of people are like, oh, I don't worry about what's happening over there. And I've been talking about supply chain and all that for years. And people are like, I don't worry about supply chain. But when COVID hit and that supply chain got, blocked up, and you had to pay twice as much or 3 times as much because your stuff is sitting out there in the ocean. So it's, those things are factors that you have to consider, especially when it comes to, your finances. But the most important thing is you got to take action. I don't care, how much and how much think how much strategy you have, but if you don't implement it or take action in doing what you need to do, then what good is it?
Good question here from Callie.
Okay.
And Callie, do you want to ask that question? Do you want, if you want to ask this, I want to make sure I'm getting this right. She's asking if a book cannot be for business and have tax write-off via an LLC. I may not be saying the question correctly, but Callie, if you'd like to
Yeah,
go
can
ahead
Yeah,
and
that's
ask.
pretty much kind of what started coming to my mind is like, I thought that when you're doing a business, that you get a tax write-off for the business if you're having an LLC or through that. But if you're doing a book and you're making profit off the book, how come that wouldn't be considered part of it?
Well, it is considered part of it because, even if you make money off the book, there's still expenses that are affiliated with, marketing the book, writing the book, publishing the book. So they're tax advantages to that. And
Oh,
like I said, that's where the strategy comes in. I'm not saying don't make money, but I'm saying take advantage of the tax write-offs. A lot of people don't write off mileage, and they're running all over the world, trying to market their book, but there are things like, so you got to have the right tax professional, and a CPA isn't always, if they're not a tax accountant, they may not be the best person to advise you on how to handle your taxes. You have a CPA, but you need a tax accountant if you want tax strategy advice. Not saying that CPA can't give it to you, but it's just, they're more generic. So, but no,
and
having
that's the
a
best
book,
way to go then, is to having it underneath the business, the LLC, is when you're doing books or having books.
yeah, anytime you're doing anything, you want to keep personal and business separate. Having an LLC, the advantage of an LLC, it keeps you from having that personal liability. Say you write a book and it's under your personal and you didn't do it as an LLC, and somebody says that I took it, advice from your book and I got hurt or I got injured or something like that, they can sue you personally for that injury or whatever. But if it's under the LLC, they'd have to sue the company. And you just make sure you're structured to take that personal liability off of you.
Oh, cool. This is all new information about the books related to business and taxes and stuff. So thank you.
Yeah. Okay, good.
Other questions? I've got more, just because I love where you're going with this. You've talked about market volatility, and I think your indexing chart showed there are ways to avoid, getting dinged for those times when the market declines. What about inflation? That seems to be a big concern for a lot of people. How can a person protect themselves and financially be, shielded from the effects of inflation?
Well, that's a tough one because inflation is going to happen. I mean, the only thing I could say is to just be in a position to, increase your income without getting that second job. Use those credit cards and get those points, but pay them off, and if you have to carry a balance, that's okay. But, at least you're getting the points. So it's kind of offsetting some things. But then when you're in a position to pay it off, pay it off. So, that's what I found. Inflation, like I said, my pain of inflation isn't as bad because I got points galore, from traveling, when you fly, when you rent cars, when you buy groceries, buy gas, get those points, whether even if you don't use a credit card for that, they're debit cards that will give you rewards points. So make sure that whatever you swiping, you're getting some points for it, because that is what helps with the inflation. Inflation is like getting on my nerve, and everybody's nerves, because when you go especially when gas was like $6 a gallon, I use premium in my vehicle. It's like, good Lord. But I, like I say, I shop at Kroger, and I was at a point where I was getting $1 off a gallon. And, I'm like, okay, I'm loving this, even though I still wasn't like paying $5. But when you get $1 off, that's $4 a gallon, but it still makes a difference, because my car, I think, holds like, I don't know, 30, 40 gallon, whatever it is, it was costing me $100 to fill it up. But, take advantage of the points and rewards, because even if it's not inflation or anything, you still want to benefit from, spending your money, because you're going to have to pay those bills. You're going to have to do whatever you do, but do it with a method that's going to give you a return.
I want to go back to what Callie was referring to, especially like when we reach, I think when we reach retirement age, most people are counting on, well, at least then I'm going to be in a lower tax bracket. I'm not going to be paying as much in taxes. But if a lot of your deductions, have grown up and moved away, or you paid off your house and that kind of stuff, it seems like maybe that's not quite as certain a thing as it once was.
It's not, because, Alex, I do taxes, and I've got some clients that made major money when they were working, and they're getting major money in retirement. But like I said, the kids are grown, the house is paid off, and, they're not getting all those standard deduction or itemized deductions that they used to get, or all those benefits. But that's where the business comes in. You want to have, you don't even have to have just one business, have multiple businesses. And you'll have one that could be making you money, and then the others can be losers, because for tax purposes. You don't care about that because you want the deductions. You want to be able to write things off. And, having a business is the way to go. You got to have a business. A lot of people say, I don't want to do it, or else they're doing something under the table. It's like, get it from under the table. And I said, well, I'm not really making money. That's why you want to write those things off, but if you make it a legitimate business, then it's not going to be a problem when it comes to writing off. If IRS says, okay, we want to audit you, you got your records. It's a legitimate business entity. It, it doesn't have to make money. You want to have one that's not a winner or a money maker, but you're going to have a money maker. But you need those tax write-offs, because like you said, kids grow. Once those kids grow and and move out, and the house is paid for, cars are paid for, you're not going to have those same deductions you had back in the day.
Okay, other questions? Hopefully, I think we got Callie's question answered. Callie, if there's any more, feel free to jump right in and ask. Of course, we've got links in the chat to Dr. Wendy Labat's bonus material here. I'll tell you, watching your presentation, the only pang of regret I felt was, man, I wish I had known this when I was 18, or at least cared about it when I was 18. Man, the earlier we can get our kids or our grandkids started, understanding like the principle of 72, or the rule of 72 rather. Wow, what an advantage.
And see, that's what's wrong. A lot of us, we weren't taught this stuff in school, just general things. You have to really, and that's why I'm on this crusade, because I was like, okay, Lord, I'm happy and healthy. I'm wealthy. I'm in my comfort zone. I'm good. And that was after the cancer. And he's like, no, you getting out, because I brought you out better than, when you went in. So you're going to empower other people. And I just recently had open heart surgery back in July. And I mean, I got a scar from here to here, just because I went to get a clearance for eye surgery. And then they discovered I couldn't get clear for the eye surgery because I had to have open heart surgery. It's like, what the heck? And I still got to wait another 3 months before I can have the eye surgery. But, God's looked out for me. It's just another part of my story, another part of the journey, and now I can actually, get around better. I'm, don't huff and puff. I'm not as tired. So he's just energizing me to continue my crusade. So I'm okay with that. So did anybody have, okay. I didn't know if anybody had questions. Like I said, I wasn't sure if I was supposed to be talking about a book or whatever, but since I'm in finance, I figure whatever you do, whether it's a book or whatever, you need to know how your money works.
Any other questions? I think we'll probably, if there are no other questions, we'll probably go ahead and take about a 10-minute or so interlude here. Dr. Wendy Labat, thank you so much. That was super informative. I've got a couple of kids that I wish could have sat in on this.
Can I put my link to my show in the chat? Because like I said, there's some good episodes that really go into more detail about, some of the things. Okay, www. Keywords. Talks about branding, talks about networking. It's 24/7 streaming. So if you go on there, you can just see, what episode you're interested in. Just watch it. Doesn't cost anything. But it's been really, people have been very enlightened, I should say, by it. So you can copy that link, and if you get a chance, just at your leisure, check out some of the episodes.